Petty cash funds for accounting for business decisions A. So your boss approves for you to pay for the new stationery for the staff at work. Great, but how do you pay for it? This is where a petty cash fund comes into play. A petty cash fund is an amount of cash kept on hand to pay for minor expenditures, such as office stationery. While the size and scope of a petty cash fund will vary across businesses, its operation will involve the following three activities: establishing the fund, making payments from the fund, and replenishing the fund. A petty cash fund is established by writing a check for the amount of the fund, cashing the check, and placing the cash under the care of an employee designated as the custodian. A journal entry is then made to record the establishment of the fund, where petty cash is debited and cash is credited, both for the amount of the petty fund. After the fund is established, the cash is used to pay for qualifying expenditures. Payments are usually made in one of two ways. Cash can be taken from the fund to make payment, or employees can seek reimbursement from the fund for payments they have personally made. It is essential that in either case, the custodian should collect receipts and authorizations for the use of any cash. This is because no journal entries are made when payments are made from the petty cash. Journal entries are only recorded when the fund is replenished. As the cash in the fund decreases, the fund must be replenished. To do so, the remaining cash in the fund is counted and the business cashes a check for the amount that brings the total cash in the fund back to the original balance. The receipts in the fund are then used as documentation for recording expenses. This can be seen in the example. The petty cash fund, which originally had $100, only has $15 remaining and requires $85 to replenish the fund. This $85 can be accounted for using the receipts in the fund, which also equates to $85. A journal entry would then be made by the business, which would debit all the receipts in the fund and credit the amount that is due, which is $85 in this example. However, sometimes the cash needed for replenishment will not equal to the total receipts. This can be because sometimes the custodian will not obtain all the receipts or will give incorrect change, resulting in discrepancies between the cash needed for replenishment and the amount of receipt. When this occurs, the discrepancy is charged to an account called a cash over and short. Cash over and short is a temporary account that can have either a debit or credit balance depending on the situation. A debit balance increases expenses while the credit balance decreases expenses. This temporary account is then credited in the general journal to account for any surplus or shortfall which occurs. And this is the entire process for a petty cash fund. Thank you for watching.